Next, we'll be hearing from Ned Naylor-Leyland. Ned is from the UK and is a fund manager at Jupiter Asset Management. He specializes in investments in gold and silver and will talk about gold's ongoing luster.
Hello everybody, my name is Ned Naylor-Leyland. I work for Jupiter Asset Management in London as a portfolio manager on our gold and silver strategy, which is both investing in bullion and gold and silver mining equities, select ones. And I'm here today to talk to you about the gold market and the silver market overall, to try and make sense of what's going on and hopefully add to your knowledge base on what I believe is an extremely important subject that isn't well covered and crucially is fundamentally misunderstood by investors. This is basically due to the fact that the dollar gold price, or the sterling gold price, most people look at the dollar gold price, is really a figment of your imagination. What I'm trying to say is that what actually happens is that gold measures the loss of purchasing power of dollars and of sterling and of euros and of South African rand, no matter what it might be. What's really happening is the chart of gold is upside down, and we're resuming a period of loss of purchasing power versus the risk-free instrument in an accelerated fashion. And the way I see this is a bit like one of those slinkies that go down the stairs. Effectively, fiat money goes down the stairs like one of those slinkies. It has periods where it will hit the bottom and then bounce slightly before it rolls again. But we're at one of those periods where, due to negative real interest rates, central bank policy, and central bank forward guidance, that we're on an accelerated trend of sterling lower, dollars lower, etc., versus the true risk-free instrument of the system, which is gold. Now, I'm repeating myself here because I want people to understand that if you buy physical gold, and Krugers or American Eagles or whatever other tax-free gold coin that your country has, are a wonderful savings instrument. But I want you to understand that physical gold is actually disinvesting. Not only is it not an investment, it's the opposite of an investment. What you're doing when you buy physical gold is you are removing yourself from the arena of investment, and you are re-entering the risk-free, and it will hold its purchasing power very, very well, or frankly perfectly, against goods and services over a medium to long time frame. That's evidenced, by the way, through various academic studies and books, but also just basic observation, which is gold is the constant, not dollars and sterling. Now, this is important both for understanding, but also in terms of the way you might think about portfolios, because if you take 6 or 7% of a portfolio and put it in physical gold, it will have a decorrelating effect demonstrably on portfolios. But it doesn't have much attribution because it's just cash. It's good money, sound money. It's the finest form of cash you can hold in a portfolio, but it is a cash allocation. So it doesn't run very hard. So what we do is we construct a portfolio which has both physical and mining equities in order to drive attribution. And I would press you to think about that because while physical gold is attractive and it's going to continue to go up, in my opinion, i.e. sterling and dollars will continue to go down versus the risk-free, there are rare moments where you want to expand beyond the risk-free and become active in the observation of what's going on with gold and silver and with sterling and dollars and rand. And those active expressions are obviously very varied. There are many ways to do that. But for me, the best are silver because of its natural beta and mining equities, which can only function really well in the kind of environment we are now, where costs are flat and falling, while spot silver prices and gold prices are rising in a sustained fashion. That gives you optionality to rising prices. And we haven't historically had flat of falling costs. We've really had fast and rising costs. And that's why the mining equities have been a very difficult area for investors for 20, 30, and 40 years. They just simply haven't had the ability to deliver sustainable margin expansion. But just wheeling back slightly on this point about what gold and silver are, and the fact that they don't have so much attribution in their form as bullion or as a gold ETF that one might buy. This is important because when you buy gold and silver as cash or within the foreign exchange arena, you are buying it for the right reasons. So you're doing it in that channel for the right reasons, which might be you have too much cash, or you don't want to own fixed interest. Gold or silver held in direct form are cash-like instruments, and their move on real interest rates. And at the margin, lots of global investors are doing that. So they're looking at their cash, their fixed interest weightings, looking at the direction of real interest rates and saying, we want to reallocate towards the physical. And you're seeing that. But we also have this additional phenomenon, which is that global equity market investors, or even broader generalists, have an issue with both their alternatives slot, but also their broader equity market slot. And we are already starting to see, but I believe a very strong trend that will continue into the future, is generalist equity investors who've either had no allocation to gold or silver miners, coming from a zero allocation to a small allocation, and then in due course in line with indices, and then in due course overweight versus indices. And this is going to be the thing that really moves gold and silver miners to the front of the minds of global investors. It would just be performance, and it would be performance driven by participation, and participation is still at all-time historic low levels, albeit the performance of the mining equities with rising dividends, clear change in free cash flow dynamics, and in a sustainable way, is offering a really sensible and obvious better investment opportunity than, for example, financials or any other area really in this current macro environment. You know, these companies are actually about to mark at the end of September, so reporting will start in October. They're about to mark their best quarter in our memory, as in not just my market memory, anyone's market memory. Genuinely, the third quarter will be the best we've seen. If we get a fourth quarter that is similar again, then you're going to find global investors start to realize that this trend of massively improved performance and really impressive earnings and earnings growth, you're going to see rotation. You are at the margin, and that, of course, is what Mr. Buffett and his purchase of Barrick is all about too. Something which I think is also relevant, and I refer to as history repeating itself, is the cycle of the 1970s. So for a long time, I've talked to people about the fact that I feel the current environment is very similar to the 70s, which of course culminated with collapsing real interest rates and rocketing gold and silver prices, which only ended with Chairman Volcker at the Fed raising interest rates to 20% in order to raise real interest rates high enough to make people sell their gold and silver. It's an incredibly important moment in modern financial market history, that. And it came about due to Nixon closing the gold window in 71, which was seen as madness. People bought gold went up. But then we entered a period of consolidation of about 4 years in the mid-1970s. Gold price corrected 50% during the mid-70s. Very similar to what happened post the peak in 2011. QE was similarly shocking to Nixon closing the gold window. The market's response was very similar. And we've had that same consolidation phase. And the key thing here really is in I think it was late 78, I might be wrong on the exact year, but the back end of the 1970s, the dollar gold price reached a level where it had been in 1974. and it breached it to the upside. And I think if you look at the charts, that was clearly a very, very important psychological moment for investors, where the previous high in gold was breached and people realized what was going on. And that led to a huge move higher for gold, and silver went to $50 an ounce, which in today's money is several $100s an ounce, by the way. It's currently $26 an ounce silver. And we're about to have that same sort of move, in my view, caused by gold breaking 2000 on a sustained basis, and the market accepting that. In other words, what we've seen is an important move in gold, but I don't think you could call it a confirmed sustained breakout. I believe very strongly we're about to get that, and that will drive the big move, because then people will know it's happening properly, and you'll start to see capital pour in. And then I think we will see a move similar to one in 79.80. The big difference, of course, is no one's going to be raising interest rates to 20% in order to put the genie back in the bottle. And not only is that true, but Powell has told you explicitly he will be doing the opposite. That he will be like Moses parting the Red Sea for investors, telling you to buy gold. And what I mean by that is dollar gold is the opposite of dollar real interest rates. In other words, low real interest rates equals high gold. And he is holding both components of real interest rates open for investors by promising to try and create inflation at the same time as promising he's never going to raise interest rates. And that is an absolute flip of the natural condition of central bankers, which is to underreport and frankly lie about inflation and to overpromise on interest rate hikes. The reason they do that historically is they want to make their paper look good. But now I'm afraid the financial system, the yield curve, is in such peril that they're giving up on real interest rates. And he's communicated very clearly that now is the moment to run across the dry seabed of the Red Sea and seek safe harbor on the other side in gold and silver. And I think that we are at that point that we were in the late 70s, where the market suddenly gets it and realizes what's happening. And of course, it's also true to say that the amount of investable capital now compared to then is incomprehensibly larger. So even when I tell you that silver in today's money hit several $100s an ounce in a similar macro environment, there is now so much liquidity in the system that I have no idea what that means on a monetarily adjusted basis. But hopefully that historical analogy has some value, and you'll realize that time and markets and market behavior are cyclical, not linear. We all get sucked into the idea that things are linear. I think mainly because we learn that in history around the edge of a classroom, time moving like this. But it's not, it's cyclical. Clocks go round and round, don't they? They don't go in a straight line. And what we see at the moment is so similar to the late 70s. You had war in the Middle East, a petrodollar crisis. You had mass strikes. You had all sorts of weird sort of similar trends like punk music. And honestly, the similarity goes through all sociological, political, and market-based environments. And I think the most important one is shrinkflation, which also was rampant in the 1970s, before the system really started to fall apart in 78, 79, 80. Manufacturers were widespread fiddling with your goods and services and changing the price to hide the real inflation in the system. And we have that in an appalling way now. Last Christmas, well, by the way, this isn't the start of me singing, in case you thought it might be. Last Christmas, I did a test, which is in London, we have a very famous chocolate brand called Quality Street, which has been around since certainly the 50s, might even be the 40s. And I actually am so boring that I bought an original Quality Street tin off eBay in order to find out how many of the modern Quality Street boxes that I could fit into the original one. And the answer is 5. So you have to buy 5 Quality Street boxes to fill a box of Quality Street. Now, if this doesn't explain well what's going on you should reconsider and think about this a little more. It's rampant. The manufacturers are very sophisticated in what they do. Things like new best ever recipe. That just means less ingredients for the same price. And it's very brazen, the behavior, and it's simply because they don't want to pass on price increases. And the system is in real danger at the moment because we have inflation in real goods, like I've just described, and yet we have financial system secular deflation caused by effectively management of statistics, in favor of the state and the corporate. What I mean is, if inflation is really being 4 to 6 and they report it at 2, the individual is the person that bites that and eats it up, and you get populism. And of course, it also supports the corporate and the state. Keeping rates too low while inflation is higher than is reported is powerfully repressive of both the individual, but also supportive of the state and the ability of the corporate to borrow. And all of this manifested in a big populist nightmare at the end of the 1970s. And I see both Trump, all the other geopolitical things you're seeing, as very representative of that overall problem. And the solution to all of it is gold. Gold has to return to the formal monetary system, and frankly, it already is. And we can see this both in the behavior of member central banks, who are, where they're able to, buying more. And when I say able, I mean creditor nations can buy gold. We can't. The US can't. It would be the equivalent of sticking a Jolly Roger up and admitting that they are pirates. So they're unable to do it. But also in terms of the language being used, there's lots of language about a neutral reserve asset being required, etc. And all it really is a return to the agreement of Bretton Woods, which is that we would use the dollar. The dollar would clear international trade, but it would have to be fixed and have discipline. And remember, central banks hold gold and they hold each other's bonds. One requires no credit rating and is the risk-free instrument of the system. Well, only one of those two things is. And the other one will dissolve into the risk-free instrument at the moment of reset. And again, if you listen to whether it's Lagarde, the IMF, the World Bank, the G20, they're all talking about reset. And it will reset to gold. And by the way, a lot of sociological problems will be resolved by returning to sound money. It's just a long cycle. And anyway, hopefully that point about the 1970s adds some context and maybe even some evidence to my contention. The next thing I'm keen to talk about is the relationship between gold and silver. I touched on it earlier, but I think it merits a little further development. Some people will say to you that silver is an industrial metal. It's nothing like gold. It's not held by central banks. Therefore, why would you own silver? And why are you even talking about silver when you talk about gold? Well, those people don't know enough about the subject. I'm going to be generous in my language. Gold and silver are one thing. Silver, in fact, is the primary monetary metal of history by a long way as well, not even close. Gold was always the collateral money of kings. You buy a city or a state with gold. Silver is the money of the people, and it always has been, and it therefore is the enemy, of course, of the state and its agents, to be clear. And silver was just demonetized 50 years before gold. This is why people have forgotten. So people have forgotten about gold because it was 1971 when it stopped being a formal part of the monetary architecture. And silver was demonetized nearly 50 years before that by industry. So industry lobbied Congress and managed to get silver removed from coinage and the monetary system because the silver was too useful to Ford, General Motors, the US military, Dow Chemical, etc. They wanted their silver nice and cheap, so they lobbied it out of existence in the monetary system. But the word dollar, pound, yuan, renminbi, shekel, plata in Spanish-speaking countries, argent in France. Silver and money is the same thing. It's one word. It's silver is money. It just doesn't exist in abundant above ground form anymore, which of course allows for really profound potential squeeze upside in silver, because there just simply is very little of it above ground. It's consumed by solar cells or your mobile phone or even the screen you're watching this in. All consume silver in tiny amounts. And if these industrial users start to get genuinely nervous about supply, and they should already be very nervous about it. I don't really have time to go into lots of detail on that, but they should already be worried about it. Then they become price insensitive buyers. If you buy silver for a fridge or a phone, and it's 0.1% of the input cost of that product, it doesn't bother you if silver's $400 an ounce. It doesn't matter. What matters is securing supply. And the way that silver has been lobbied out of existence, frankly, by greedy industrial users, just gives the potential investor in it a really interesting additional upside variable. There's no downside to what I've just said. It's all upside squeeze potential. And the gold silver ratio at the moment is in the 70s. So what that is 1 ounce of gold divided by an ounce of silver, expressed as a number. It hit 127 to 1 in March because of the rising real interest rate environment we were in. The forward inflation expectation collapse that we saw in March was bad for both metals, and the relationship rose to 127 to 1, which is the highest certainly in modern recorded history. We're now down at 70, and it will keep falling so long as capital flows towards gold. So silver is about 1/10 of the size of gold, maybe slightly smaller than that, maybe more like a 20th. It's still very big, by the way, because the gold market is, we don't really know, but $200 to $500 billion equivalent per day. So silver might be 20 to 40 billion a day. Of course, most of this is paper, not real physical. So there's huge turnover, and if capital flows in size towards a sector, then the ratio should keep falling to the benefit of silver and silver explorers and developers and producers, all of which are trading cheap relative to historic multiples and have profound upside gearing to rising prices, because silver miners, partly due to what we've just discussed, have materially lower operating margins than gold miners. So as the silver price rises, there's a greater compounding payout option value, as it were, or option payout relationship as compared to a gold producer. So we're starting to see a little bit more interest in silver miners on that basis. It wasn't a huge surprise to see Newmont, Barrick, etc. do very, very well at the beginning of this move. They will. They're free cash flow monsters. They have $1,000 operating margins. This is wonderful if you want rising dividends and you want to talk about free cash flow, but they, equally will need another $1,000 an ounce on the gold price in order to double their operating margins. Whereas silver, $10 or less, and we're doubling the operating margin. So silver has much more exciting upside potential, both in real terms because of the current market, but also these historic relationships. There's about 10 times as much silver mined every year as gold, not 70 times. It's well out of whack. And we believe strongly that is a real opportunity for investors who will look past just pure physical gold, which, as I've said to you, isn't even an investment. I'm coming short of time here, but I want to just come full circle and talk about that point about disinvesting in physical gold one last time, using a personal anecdote. Because if I can impress upon you this point, then I think the whole thing makes a lot more sense. So I put a small inheritance, which I had in 2002, in physical gold. And I did it for all the reasons that you would do it now, which is systemic risk, the likelihood of a reset, and effectively repression of holders of sterling, dollars, etc., through central bank behavior. However, when I did it, I thought that it was an intelligent investment call. So in other words, I was making an investment decision and it was a good one and I was going to do very well out of it. My gold is up, I'm not even sure, in sterling it's probably up about 7 times, something like that, over the near 20 years since I did it. But it hasn't done anything at all. And it never was going to. What I did is I disinvested. I chose to not participate at all in the financial system. I took all my capital. I put it in the corner of the room and I said, I don't trust any of this, I'm out. And here I am 18 years later. It has 7 times the price that it did then, but my gold buys me the same goods and services as it did when I did it. You're not even making an investment decision when you buy gold, you're understanding. When you buy physical gold, you've remembered and you're understanding what investing is, which is to leave physical gold. As soon as you leave physical gold, you're investing. So in other words, sterling, rand or euros or dollars are preposterously bad investments. They're not cash. You're just getting butchered holding them. And look at the sterling gold price or the rand gold price to understand that point, which is you should hold your savings, your cash, your non-investment pot in the risk-free instrument of the system and not in your domestic government-issued money. So I learned about this the hard way, which is I thought I was making a very clever investment. And I now realize not only was I not doing that, I was doing the exact opposite of what I thought I was doing. I was actually removing my capital from investment and saying, I don't like any of this. And that still has merit as an observation. But we believe, and I would impress on you, that you can take that and make it active at this point in the cycle. Understand that the observation is still right and you should do it. But now you can be active. You can buy silver and you can buy mining equities and you can take what is a genuine, passive, disinvesting view and turn it into something a bit more interesting and more relevant to this point in the cycle. And with that, I will stand down. I've run out of time. Thank you for your attention and interest. And back to the studio.